tax-free money. That sounds pretty good.
It's a scam.
Right, Valerie?
It's got to be a scam,
Yeah.
right?
I mean, it sounds pretty good because most of the time, well, it is good, at least if you're following the tax code. But just because something is financially attractive does not mean it's straightforward, especially in America. That's especially true. It seems to be the first principle of like personal finance. Just because it's attractive does not mean it's simple, right, Valerie?
Mm-hmm.
And that's why we're going to talk about 5 big Roth mistakes that we see. Again, Roth, tax-free money, sounds fantastic, but that does not mean that you still can't make some mistakes. We're going to go through 5 mistakes. My name is Michael MacKelvie. I'm a certified financial planner with Herein Wealth Advisors. I'm with Valerie Escobar, who's also a certified financial planner with Herein Wealth Advisors. This is Your Life Simplified. If you're listening on YouTube, Apple Podcasts, Spotify, make sure to hit that subscribe button. If you're new, Valerie, we got a lot to talk about here.
We sure do. Yes. Where do we start?
I think we start with just in general, missing Roth opportunities. So,
Yep.
I think this is one that, again, a lot of people just don't realize that they have an opportunity on the table. They say, I make too much money. So what are some of those opportunities that people miss sometimes?
Yeah. And so first thing is that, yes, you can make too much money, but one of the qualifications for making a Roth contribution is you do have to make earned income, right? And so like getting dividends from your stock account doesn't count as earned income. If your child is 4, unless he's like a baby model or something, I don't know, he's not getting earned income. You can't
for
make
Gap.
a contribution. Yeah, it's a Gap baby. Then
I don't know if there's Gap baby models, but there might be.
Probably. But there is a little loophole or a little extra caveat that the code allows for, which is making spousal contributions. And so if you're working and your spouse is not working, and assuming that when you file, your income is below the threshold for making Roth contributions, you can make a contribution for your spouse. If we simply called a spousal IRA or spousal Roth IRA. And so, take advantage of that and put a little bit of extra there.
Yeah. If your spouse has the availability there, again, make sure to double check into that. And again, that earned income distinction there is critical. So Roth 401k opportunities as well. A lot of people just don't realize that they have a Roth 401k opportunity on the table. They say, I make too much money for Roth IRA. Well, you might be able to contribute if your employer offers a Roth 401k option to your Roth 401k. So maybe you get a little tax diversification in your plan and you say, okay, well, maybe I put more money into my Roth 401k next year, or I change it up towards the end of this year because I'm going to be just under this bracket. Again, check and see what Roth 401k options are out there. I see that so frequently. I know it seems, I think sometimes I assume that people know that because their employer maybe is educating them on it. They unfortunately might not have. So check and see if you got a Roth 401k opportunity there, right?
For sure.
I have another one real quick on just Roth 401k opportunities. And this is after-tax opportunities. So quick distinction. We're talking distinctions, right? You have a Roth 401k optioned a lot of times through an employer. You have a traditional 401k. So you can contribute to either of those. You can actually even contribute to both. Now, you might also have an after-tax 401k contribution. And this is different than your Roth. Sometimes people say, well, when you hear after-tax, you assume it's Roth. Your employer might give you the ability to contribute to an after-tax account, which you can convert to a Roth account. Okay, so I see that as a missed opportunity a lot of times. People just don't know that they have that after-tax opportunity, and a lot of employers have it, right, Valerie?
Yeah, no, and that's a great point. It's just that, when you make a contribution to a traditional 401k or IRA, you're getting to deduct the money from your income tax, right? So you're paying tax on less. With the Roth, yes, you're going to pay the taxes now. It grows tax-free, then you don't. But I mean, putting money into that Roth IRA, however you can, is super important. So definitely an opportunity there. Number two on our list is losing your cost basis. This can be huge. Cost basis is the amount of money you paid basically the amount of money you invested initially. So let's say I opened my Roth IRA when I was 16. I put in $5,000 and then I never touched it again. Now I am, I'm 29 now. Thank you for not laughing. But so I am 29, we'll say, and my Roth IRA has grown from $5,000 to $30,000. Let's say that I decide I want to take a distribution of that. The cost basis, or that original $5,000, that is after tax money. So that was my money. I put it in there. I can take that back out without paying taxes or penalty, but I have to know what amount that is, right? And so if I go and I distribute the whole thing, don't do that. It's bad. You should not touch your Roth if you can avoid it. But if I decide I'm going to do that, I need to have a record of my original contribution so that I don't have to pay taxes on that $5,000 again. So that's something that has been frustrating.
It's super important, right? And I think that leads into just something. It's probably, I'm going to switch it up here a little bit because I think it leads into this better, forgetting the 5-year rule. So if you are indeed taking money out of a Roth, there's this 5-year rule that not that many people know exists. And that is, if you're taking distributions from the Roth IRA, you have to typically meet a 5-year rule if you're before the age of 59 and a half, sometimes actually after the age of 59 and a half, if you're taking out earnings. So now if you put money into a Roth IRA and that's your basis and you're just taking out what you've contributed, you can do that without an issue. But if there's growth there, then you might have to pay income taxes in a 10% penalty. So something just to keep in mind is there's this 5-year rule. I won't get too deeply into it because there's a lot of specifics to this, but just understand anytime you're taking money out of a Roth, understand that there could be this 5-year rule that could come into play where you might have to pay taxes or a penalty on it. Yes, you can take out your basis, but and you don't want to lose sight of that, as Valerie just mentioned, but you might run into this 5-year rule. So something to keep in mind.
So let's see, that is number 3 on our checklist. So let's see, for number 4, I'm going to jump into backdoor Roth contributions.
Let's do it.
This is that piece really adds into that 5-year rule, because when you do a backdoor Roth, there's so many different mistakes you can make, right? So a backdoor Roth means that you're taking money from your IRA and you're converting it into a Roth IRA. And you do this when you make too much money to be able to contribute to that Roth IRA, right?
Yep.
When it gets messy, though, is that usually you want to have let's say that Samantha, our friend Samantha Bond. Samantha has an IRA with $100,000 in it. And she's had this traditional IRA. She's had it there forever. Let's say that she now decides, you know what, I've heard about this backdoor Roth strategy where I can put $5,000 or whatever amount, $5,000 into a non-deductible IRA, meaning that she makes a contribution, she makes too much, so she's not going to deduct it on her taxes. And then she wants to immediately convert that into a Roth. In normal circumstances, because you put all the money in right now and then we converted it immediately, there was no growth, right? It was, the cost basis was $5,000. The problem is that the IRS considers all IRAs, it's actually an individual retirement agreement. It doesn't stand for account, it stands for agreement. So all of your IRAs are like one big bucket. And so because she has $100,000 of after-tax money and $5,000 of pre-tax, or the other way around, there's some pre-tax and after-tax money put together, the $5,000 she converts is going to be a mixture of all of that. So she will have to pay taxes on something. It basically just becomes a tax nightmare. Don't do it. If you're going to do a conversion, do a conversion. If you're going to do a backdoor Roth, do a backdoor Roth, but only if you don't have any existing traditional IRAs.
Yeah. It can get complex quick. Again, I think it's a good reason to consult a professional on it, because it's just going to cause more time and headache than maybe you want to take on. I mean, you can certainly feel free to like weed through Investopedia articles for like a few weeks at a time, but I just think it's probably best to have somebody you're talking to on that. Now, number 5 is just contributing when you're not eligible. So I've actually run into this where, I'll meet with a new prospective client and they have contributed to their Roth and they just aren't aware that they can get phased out of their Roth IRA. And this typically happens is people are progressing up the ranks. They maybe are starting to make more and more money and they've gotten a promotion and they have this big new income year. And they contribute to a Roth IRA and they realize, wait a second, I can't actually do that. So you might have to back the money out of the Roth IRA if you did that. But keep in mind, there are limits. There are income limits. So married filing jointly, $204,000 to $214,000. So that's a phase out. So you could contribute the full amount at $204,000 and below. And then it phases out to zero between $204,000 to $214,000. So as you progress through that income bracket, you basically can contribute less and less until eventually you can't contribute anything if you make $214,000 or more. If you're single, had a household, or married filing separately, $129,000 to $144,000. So it's lower. Now, just again, keep in mind here, that's why we covered first missing Roth opportunities. So it's kind of funny how I've always found this funny. I don't know if you agree with this. There's all these rules around contributing to a Roth IRA, but then there's all these ways to get money into the Roth bucket that kind of get around all that. And so again, if you phased out of it, that's the reason to look to what we first talked about, which is just missing Roth opportunities by way of your employer or a spousal opportunity. So just keep that in mind, right?
Yeah, absolutely. And it gets hairy, right? Because like with the phase out, right? Exactly how much can I contribute if I make somewhere in between that? Consult a professional. Your CPA would be able to tell you. If you're married filing separately, were you living with your spouse? I mean, now we got to get into your personal business. What is the status of your relationship? Because if you are living together and everything's happy and healthy, you just don't like doing your taxes together.
You ask me that all the time, Valerie.
I do. I don't have a filter regarding that. But yeah, I mean, if some people want to keep their lives separate, well, don't do that. Let's all be open about what's going on in our lives. But if you are married filing separately and you're married and living together, your phase out is $10,000. So basically you're done. Like you can't make any Roth contributions at all. So just kind of little nuancey weird things that, just got to keep your eye on. Luckily we're nerds and we love to try and keep all of this stuff in our brains, and we're always on the lookout for the new stuff. Yeah.
Again, as we spoke of at the beginning, just because something is good does not mean that it's straightforward. Doesn't mean you can't run into some roadblocks, some hurdles. So hopefully you found this helpful. If you're new here or if you haven't subscribed yet, make sure to hit that subscribe button to follow along for more industry insights from industry professionals here at Mariner Wealth Advisors. Valerie, thanks for helping out. 5 big Roth mistakes. You guys take care.
Bye.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Roth IRA conversions are complex, and treatment depends on the type of IRA that is being converted to a Roth IRA. The views expressed regarding Roth conversions are for commentary purposes only and do not take into account any individual personal, financial, or tax considerations. It is not intended to be a solicitation to buy or sell or engage in any particular investment strategy. Before initiating a Roth IRA conversion, please consult with a financial or tax professional and ensure you consider all your available options, including applicable taxes, fees, and features. A distribution from a Roth IRA is tax-free and penalty-free, providing the 5-year aging requirement has been satisfied and one of the following conditions is met: age 59 and a half, disability, qualified first-time home purchase, or death. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.